Hi everybody, Luke Gromen, FFTT. Hope you're well. Hope you're having a great week. I'm going to jump right into today's quick update. For the first question is from SM. What are your thoughts on the recent news that Saudi is willing to transact in currencies other than dollars for oil? And a follow-on question related by KC. If more countries settle their oil exports in China in renminbi, how does that impact China's domestic consumption? Most of the commentary that I have seen around these comments out of Saudi since they hit, I guess it was yesterday morning, they continue to miss the point. These comments just completely miss the point. You need to start with China's balance of payments and work backward from there. Instead of having to use finite dollars to buy energy, they can start buying more of their oil in their own currency. That has the ability to increase their trade surplus as they buy in yuan instead of dollars. The more their trade surplus increases, the less of a risk there is of them running out of dollars, the more of an ability there is for China to manage the yuan dollar cross rate through energy and commodity markets by adjusting the percentage of oil bought in yuan versus the percentage bought in dollars over time. That's side effect number one to be focused on. Side effect number two is it also structurally reduces China's need for treasuries going forward. I gave a presentation about this in 2017. Back then, China's FX reserves, treasury holdings, as a percent of GDP were 26%. They haven't bought any treasuries since then. They really haven't bought any net treasuries in any real way since 2011 or 12. So you can see China's need to hold dollars, need to hold dollar reserves, i.e. treasuries, shrinks structurally, slowly, glacially, but inevitably as they gain more of an ability to buy energy in their own currency, which is absolutely happening. And so as this model keeps being rolled out, facilitated first and most by Russia, which probably has a lot to do with why Russia has been public enemy number one for the last 8 to 9 years. It's now being quote unquote considered by Saudi. It's likely only to accelerate. And so if you these are the two key ways to look at it. Now, with this said, As I said with Grant Williams on episode 4 of our Shifts Happen podcast, quote, and I said this verbatim, now, does that mean the dollar crashes? Well, no, that depends. What it means is if the Fed doesn't print the difference between what foreigners, China used to buy and what they no longer need to buy because they don't need to store as many treasuries, then the dollar goes to the freaking moon and treasury yields start going up, which is exactly what we saw last year. So I'll be blunt. Bigger picture, any analysis on the whole Saudi multi-currency energy dynamic that does not start from a point of addressing, number one, the balance of payments implications for China, particularly as they relate to energy, and number two, balance of payments implications for the United States as they relate to structural deficits rising while structural foreign official demand for treasuries declining. You can take the analysis and throw it in the trash. It's useless because those are the two key metrics. So that's what I would say on that front. We're starting off with a bang, I guess, today. Next question from SH. What are your thoughts on the housing market and home builder stocks? High cancellation rate from KB Homes, looming recession, high mortgage rates, and yet these stocks are up double-digit percentages recently. I think by and large they are trading off sequential inflation declining sequential inflation. And the implication for that for interest rates, it's basically a Fed pivot trade or a Fed pause trade. You probably have some element of a bounce back from year-end tax selling in some of these names. And so I think that's what you're seeing go on at the moment. From HR, given the looming crisis that is at the world's doorstep, would you ever consider taking a short-term loan, max 5 years at a fixed rate, say at 4.5%? Which you can easily pay off buying gold and silver whenever prices have the correction together with rest of assets. The short answer is no. I would not do that personally. I would not advise any individual investors do that either. The only leverage I've ever sort of carried, I guess, if you will, by being long gold and silver, was the 30-year fixed mortgage I held at very low rates. I could have sold gold and silver and paid off my mortgage instead. But that kind of leverage I'm fine with personally. Any other leverage than that, I think it's important to remember, look, in Weimar Germany, they hyperinflated the currency to zero. The gold went to 1 trillion Reichsmarks over a 4 or 5 year span. With that said, there were 4 or 5 different times where people believe that it's different this time and the fiscal situation is not that bad and the Reichsbank is going to tighten and they're going to do QT and they're going to strengthen the Reichsmark and for a little bit they did. In fact, so much so that 4 to 5 separate times you would have lost all of your money if you were levered long gold, even as the Reichsmark ultimately hyperinflated to zero against that same gold. So to me, I just see no need to get cute. Hold physical gold in a correct percentage for your net worth that you're comfortable with, and then let the leverage in the system, which is really twofold. Number one, global sovereign debt. Number two, the gold and silver paper unallocated derivatives that are in the system, and let those two massive amounts of leverage work for you when the time comes. I mean, I have people sometimes ask, what's the most levered way to play gold and silver? For me, I would just hold physical because you've got all the leverage you need in global sovereign debt and in global unallocated derivatives on the underlying. The last step in that process is don't forget to pay off your house or pay down your debt or whatever it is when you get that type of spike up. June 2021 with the crazy run up in Bitcoin, as we wrote to clients in June 2021. I sold most of my Bitcoin at the time, paid off my house. Got back in too soon, but I got back in too soon largely debt-free. So from PL, the sentiment of every Wall Street guy is that a recession will occur in a couple months. Does a 10-year yield downtrend reflect that overly crowding and bearishness? I do think recession is a common view held by me as well. I also think that what we're seeing at the long end of the curve is an expression of that view. And I think it's important to kind of take a couple steps back or step back on a couple things as it relates to that view of, hey, recession, weakness, deflation, buy 10-year treasuries, which is you need to understand or break it down a couple ways for the average investor. Number one, there's a lot of funds across and investment funds across the U.S., across the world that report numbers either monthly or quarterly. And in some cases, you have a down month or 2 down months in a row, you lose your job. So these funds often cannot stand around and wait. They have to go with the near-term trend, and that can lead to a level of procyclicality. Maybe we're seeing some of that at work. I bring that up because a recession, if we have one, will quickly put at risk a nominal sovereign default across much of the West, including the U.S., on either entitlements, treasuries, DOD obligations, right? I mean, we have a big enough recession, either the Fed prints the difference or we go to Ukraine and say, sorry, we got to stop sending you money because we don't have it because tax receipts are falling too much. So the odds of that happen at this point seem slim and none, and Slim just left town, in my opinion. So that's the implication of a recession with debt to GDP this high, with deficits to the GDP this high at this point in the economic cycle in the U.S. specifically. The trick, of course, is path, right? And figuring out when number 2 starts to matter. It doesn't matter yet, and that's why you're seeing what we're seeing in the 10-year. I'll be watching to see when you see TLT start selling off again on economic weakness, on stock weakness. That, to me, will be, I think, if you see a resumption of the trend in TLT that we saw last year with weakness, that's going to, I think, be an important tell, but we're not seeing that yet. I think maybe later this year. From TW, why has the dollar been so weak lately, and how do you avoid confirmation bias? I think it's largely in the short run weakening U.S. inflation expectations, driving less Fed rate hike expectations, combined with some modest sequential tightening from the ECB and BOJ. I think you got to take a look back too and go back to October 2022. If you point out, put a date on a chart in mid-October 2022. So when Janet Yellen was at the IMF in Washington. Look at the dollar price that day, 114. Look at the dollar price now, and look how quickly it's been a straight line down. Somebody talked about something at the IMF in October 2022. I don't know what it is, but I think there's something to that. So there seems to maybe be some sort of policymaker finger on the scale, shall we say. But I can't put more on it than that because I just don't know. In terms of avoiding confirmation bias, I try to avoid that by being able to argue the other side to my views as well as I can argue my own current view. And then trying to do the best I can to understand where consensus is along that spectrum. Because really, when you make money or when you're making money, it's a function of two things. Number one, it's about being right, but equally important is positioning. And it's when you get that holy grail of offsides positioning and then you're right in the other direction that you make the most money. From DE, opinions, thoughts on how you think the Bank of Japan situation will unfold and its consequences with more focus on U.S. assets, bonds, and equities. Short term, next few months, I think the yen keeps going up against the dollar as Japanese repatriation of the net international investment position happens to try to help finance Japan again. We talked in recent tree rings that 10-year JGBs right now, there's a 200 basis point pickup versus FX hedge 10-year treasury yields for Japanese investors as of 10 days ago. So there is an economic case to reach for yield, to repatriate flows. I think that's good for the yen. I think it's bad for the dollar. To the extent it's bad for the dollar, it's actually probably good for treasuries, treasury demand, treasury yields. I think it's not great for U.S. risk assets, all else equal. Intermediate term, if this trend keeps up, in my opinion, the markets start to get concerned at some point about the sustainability of Japan's ability to sell foreign assets to finance itself. And at that point, then I think it resumes bidding the dollar. So we'll see what happens. Final question is from NP. What is worse for the West as a whole? A slow burn in Ukraine or a quick settlement? Everyone thinks a protracted war is bad for Russia and Russia only. I would have said a quick settlement 6 months ago, 12 months ago, 4 or 5 months ago. But I think we need to watch commodities here. I think the longer they keep going up despite a slowing economy, the more a slow burn, I think, becomes worse for the West than a quick settlement. Because stagflation, as we saw in 2022, is the kiss of death for Western financial systems with sovereign debt at their center when they're as levered as they are. Stagflation, to be blunt, introduces risk to the risk-free asset. And if the risk-free asset, treasuries, have risk, either duration or credit, everything else on the board, with the exception of maybe gold and the dollar, are going to have a pretty rough go of it. Maybe commodities as well, if that leads to continued constraining of supplies. So with that, I'm going to finish up for the day. As always, thank you very much for joining me. If you like these updates, check out FFTT tree rings, FFTT-LLC.com for more information about tree rings product, 10 most interesting things, brief synopsis about what grabbed our attention about them, and whether it has us changing our views or if they're sympathetic to views we'd already held. Thank you for joining me, and look forward to chatting with you soon. Take care, everybody.